This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, all hell is about to break loose for the U.S. economy, and what will be my most critical video yet. I'll show you what just happened and why it means that the U.S. economy is about to spiral down into a recession over the next 3 months. But not to worry, political elites are going to do absolutely nothing to stop it, and I'll show you why that they won't react until it's far too late. Plus, we have a sponsor of today's show. We'd like to welcome Shift Pixie to the show. You can find them on the NASDAQ under the symbol PIXY, and they're revolutionizing today's shift workforce, and they're about to revolutionize your trading portfolio. We're going to show you the initial 11% move as this is trading between some very tradable ranges with a breakout potential of 37%. And this is on the back of one analyst with a buy rating that says their stock could shoot up by 70%. Stay tuned at the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg. When we find out what just happened today as U.S. retail sales, excluding autos, rise by the most in 3 months. And what I want you to see here is how the media is spinning the retail sales story, because wait till I show you, it's telling us that there are danger signs flashing for the U.S. economy, and over the next several months it's going to get far worse. And here we can see that retail purchases, less motor vehicles, rose 0.4% last month after an upwardly revised 0.1% advance in May. Total retail sales were unchanged, restrained by a 2% slide in receipts at auto dealers, this due to a hack. And here you can see U.S. retail sales were surprisingly higher in June. Again, that cyber attack on auto dealers, had that not happened, well, the headline number would be much higher than it is now. But again, this is just a rosy story as we get underneath what's really going on in retail sales and the U.S. consumer, as consumption and economic activity have downshifted significantly so far in 2024. But conditions are far from weakening to a point that would be considered recessionary. And that's true. We are not in a recession yet, but we are on the early stages of entering one. And we have all the mounting evidence to suggest that in a matter of months, it's going to look far worse than even, of course, I think it's going to look. And we think the data on spending and growth combined with improving inflation readings support an easing in stance of monetary policy. And that's a given, because what we've heard from the Fed is that they're actually too restrictive on policy, and that this was their plan to aggressively bring inflation down and then at some point pull back by lowering interest rates a little bit. The issue is, as I'm going to show you, by the time they get around to lowering rates, it's going to be far too late. But something that's not too late to get in on, and that is the stock for our sponsor of today's show, Shift Pixie. Again, you find them on the NASDAQ under symbol PIXY. And right now their stock has been trading between ranges. You see these purple supply zones that are marked by those horizontal lines. And you can see when it gets down in the depths here, it rallies up, breaks through the zone, and all the way up here. This is a 37% return. You can see it's happened not just once, twice, and now setting up a third time. We're looking for an 11% move up to this volume profile line with the breakout here up to 37% higher on the back, of course, of an analyst who believes the stock could go up by 70%. But let's take a look at the real issue with retail sales and what's driving it, and that is consumers taking on more and more debt. And this is a dangerous move, because going into a recession, consumers are usually maxed out on their limits of their debt, and at high interest rates, it poses a problem when they finally cut their spending. But what we can see here is the truth is that consumers are unable to keep up with inflation because their wages aren't growing fast enough and they're not getting enough hours, forcing them to put more money on their credit cards. As we see here, large bank consumer credit card balances in red rising, and despite that, advanced retail sales continues its downward trend, and that is a bit of a shock. And what it's telling us is that prices for goods and services are just too high, and that consumers, while they cannot afford them, are cutting back in every possible way. And of the 13 categories tracked by the Commerce Department, only 3 registered declines, and we can see where people are cutting back. And one of those is gasoline prices, because what we note is that gasoline prices have gone higher and consumers had no budget to absorb it, so they're being forced to cut their spending everywhere they can, now traveling less. And this is really a problem for the U.S. economy, because as we talked about in the show yesterday, the summer months are absolutely critical. There's a lot of travel, a lot of discretionary spending that happens here. And for many businesses, this is where they do the lion's share of their business to get through the lean winter months. We're seeing consumers cut back. And look at this, the actual retail sales print 0, but of course the headlines are all focused on excluding automobiles and gas. Look at that big 0.8% month over month print. And that is indeed a big number, but it's going to get worse, because I wanted you to see what the media was presenting this as. And the data bucks a trend in recent months, showing a gradual slowdown in consumption growth as Americans feel the pinch of high interest rates and a cooling labor market, suggesting the economy is still holding up as the Federal Reserve nears the start of its rate cut cycle. But the issue here is, what if the economy isn't actually holding up? And to do that, we have to look at retail sales in a different perspective, because what you see is the nominal number, the non-inflation adjusted number. So when we take inflation and adjust retail sales, we get a completely different picture. One where we find out that yes, there is a higher dollar amount being sold, but of course there's not as many things relative to inflation. That's a problem for us for small and mid-sized businesses. Remember yesterday's show, we talked about how bankruptcies for discretionary small and mid-sized businesses were rising. Well, here's the reason why. As we look at inflation adjusted or real advanced retail sales, now shown in blue, what you can see here is that due to inflation, retail sales going into the dot-com bubble went negative, and that happened again going into the global financial crisis. And so why the dollar amount of retail sales is going higher, of course, adjusted for inflation, is not. And this is a huge issue for employers, because they've had to raise their prices, not just, of course, their costs for employees, but other costs have gone up, and they need consumers to come out and spend more. So what you see what's happening right now, despite the beautiful headline print that the media wants you to see when you adjust it for inflation, it's telling you that small and mid-sized businesses are struggling here, because retail sales when adjusted for inflation has been negative. And this is an issue, because now we start to say that they were saved by the seasonals, as headline from Zero Hedge, as we look at a real plunge in retail sales, because somebody who's very good at predicting is Bank of America, and they thought retail sales should be in a decline, but as it turned out, it was only flat for the month. But as we look at the non-seasonally adjusted data, what you see here is that it actually declined quite significantly last month. And this is an issue, because this makes sense of what we're actually seeing in the other data from the surveys that are indicating that consumers are indeed spending less, that don't have the purchasing power that they used to. But of course, the seasonally adjusted numbers by the government made the report look good. That's not the only thing, as you can see here. As we look at adjusted versus unadjusted retail sales, of course, notably the consumer price index being a factor, but here you can see unadjusted retail sales have been trending below the adjusted number, suggesting that at some point, as we continue to see a slowdown in retail sales, that what we're going to find out is the headline number is not going to look as great. But by the time it does that, well, it'll be too late for the Fed to react, because what the issue at hand here is, if businesses don't have enough foot traffic and enough sales, well, they need to start cutting expenses, because they can't absorb the higher cost due to inflation. And there's one easy way to do that, because you can't cut your rent, but what you can do is cut your head count. As we look at advanced retail sales, again adjusted for inflation in blue, against continued unemployment claims, and what we can go back here and see between 1994 and 1996, we saw a deceleration in demand for retail goods, and what happened, that led to an increase in unemployment and people being on unemployment, but it was very mild at the time. Well, as we look forward now to the dot-com bubble, what you see is that deceleration turned into an outright contraction, and what happened, there was a massive acceleration in continued unemployment claims as there weren't enough jobs for people in the workforce because there wasn't enough demand from consumers. That happened once again in the global financial crisis, and it's starting to happen again because what happened last week is we saw continued unemployment claims tick higher, which is indicating that at this point small and mid-sized retailers are struggling. They just can't hang on any longer. If we continue to see that continued claims number go higher, well, what it means is that retail sales number is going to get even worse. Of course, that doesn't mean we're in a soft landing. It means we're in a no landing on the way to recession scenario. And there's further evidence that the issue consumers are facing is with energy prices as oil retreats with China data and soft sentiment clouding outlook. Now, you remember not long ago, our subscribers made money trading oil. We got them in and out with a profit. And now, of course, oil sliding down. How did we do that? Well, check out the links in the description below for a 30-day free trial. While you're there, check out Shift Pixie. Put that on your hot list as the decline followed data that painted a weak picture for the world's largest oil importer as the nation's economic growth slowed to its most sluggish pace in 5 quarters. Now, this isn't the U.S. they're referring to, it's China. The issue here is what's going on with the U.S. is that high energy prices are cutting the ability of consumers to spend on the discretionary side of the economy. That's exactly what we're seeing in the inflation-adjusted retail sales numbers. And if energy prices don't come down in the near term, well, what it's going to do is put, of course, sales on the retail side even lower, leading to more unemployment, and next thing you know, it spirals out of control, pushing the U.S. economy right into a recession. And markets have felt the hand of the summer doldrums, which is a shock because this should be the time when energy prices are booming because there should be demand, and none more so than oil. Such listlessness has been made worse by the poor showing of data from China, and now what we're starting to see is weak data out of the U.S. as consumer demand here is declining, whereas notably people are not traveling like they're supposed to, and we're hearing from businesses on the discretionary side of the economy that they're not getting the amount of business they expected. And of course, we know there is a correlation to high energy prices and a weak economy and putting people on the unemployment line. We can see here as we look at U.S. regular all formations gas price in blue, and you can see there's a point where gas prices rise and it really squeezes the consumer to the point where they can't spend as much on the discretionary side, which leads to a lack of demand and a rise in unemployment until you see energy prices decline. The same thing happened in the global financial crisis, happened ahead of the pandemic in late to mid 2019, and look what's happened now. Every time energy prices go up in terms of gasoline, what happens? It's a shock to the economy and prices come down. The longer they stay up here at these levels, the risk is you see a breakout in continued unemployment claims, and that is again why we're saying hell is breaking loose. But not to worry, of course the political elites will run to the rescue, well, except they'll get there way too late. As Powell signals rate cut is coming but into view, but declines when to say when. Of course, he never will. They never do. Powell said inflation and economic activity have slowed broadly in line with the central bank's expectation as data on price pressures between April and June do add somewhat to confidence that the inflation will return to the Fed's target after inflation readings failed to provide such confidence early this year. But if retail sales continue to decline, well, absolutely inflation is going to drop, because what will happen is you're going to see retailers compete for what little business there is, and that means they're going to have to lower their prices. And I'm not going to be sending any signals one way or another on any particular meeting, according to Powell. We're going to make these decisions meeting by meeting, which is exactly what central bankers always do. You'll never know ahead of time what they're planning, because that's just not how it works. Because in reality, Powell's going to react way too late, as they always do. And officials are trying to balance the risk of moving too slowly to reduce rates, which risk a sharper slowdown in hiring, with the risk of moving too soon, which could allow inflation to settle out above the Fed's target. And what we're seeing here in the retail sales data is that if it continues to languish as it is, it means more people are going to hit the unemployment line. And by the time the Fed reacts to this, because remember, the next meeting is the end of July, and then after that, it's September. By the time September gets here, it may be already on the edge of too late. And here we can see Chicago Fed President Austin Goolsbee said he was concerned that holding rates steady would contribute to an unduly tight policy stance because with every new month in which inflation is lower, the inflation-adjusted benchmark rate is rising. We set this rate back when inflation was over 4, and hey, let's say it's now down 2.5%, which implies we have tightened a lot since we've been holding at this rate. And you can tell Goolsbee and some of the other members of the FOMC are getting worried, but they're not going to react just yet because they're going to wait for the market, but starting to give some early signs here. And we can see, looking over to the UK, 2-year bond yields fall below 4% as market eyes a Bank of England cut. And we look at the United States, we note that that is a key metric to the Fed. You can really forget about inflation, the labor market, all the other things the Fed claims they look at. If you want to know the absolute truth of what really Fed policy is set on, you look at 2-year Treasury yields. And what we can see here in the past is in red, we see 2-year Treasury yields. In blue, the federal funds rate. Is 2-year Treasury yields lead a decline in the funds rate each and every time. But what we can note here is that right now, 2-year yields have attempted to get the Fed to stop, and it didn't work the first time. They tried again, didn't get the second time. The third time, if you see a breakdown of 2-year Treasury yields, watch out. The Fed is going to go into all-out panic mode, because when we come back to retail sales, where we started today, if you have an issue of demand and consumers aren't out spending, well, what does that mean, of course, for interest rate policy? It's too high. And so to get people to consume and charge and consume, more importantly, you need to see rates come down so their debt service costs go lower. And here's the factor. What we can see is in the past, when we look at 2-year Treasury yields, again, remember, they lead the federal funds rate. What we can see is slowdowns in retail sales are matched by a decline in 2-year Treasury yields. And you can see how it does actually work. Yields come down and retail sales either bottom out or start to turn higher. And so it's critical that we see the market start to believe that we're headed into a recession and drive yields down. You can note here in 2019 upwards to 2020, rates came down, and that turned retail sales up ahead, of course, of the pandemic. This time, what we know is the market is not convinced yet, but when you see 2 years break down, well, that means, of course, retail sales are a foregone conclusion, which we expect to see in a matter of months, a breakdown of the U.S. economy by the September FOMC meeting. Do we expect them to cut? Yes, we do. But wait till you see where retail sales are at, because if they continue to decline on the path they're on, well, it means that continued unemployment claims are going to head higher. And one thing workers are going to look for are opportunities for shift work, and we're going to see our sponsor of the show, Shift Pixie, as a leader in that space. You can find them on the NASDAQ under symbol PIXY. Again, that's Pixie. Let's take a look at what the company's up to, and I'm going to show you the opportunity in their stock for what we see as a short-term 11% move that could break out to 37%. And I'll show you that analyst recommendation who believes the stock could go up by a whopping 70%. And Shift Pixie is built to reconnect business to the new workforce as the next-gen platform for employers and employees, as Shift Pixie is revolutioning today's shift in workforce. Their innovative approach to human capital and our technology deployment balances the need for business operators who rely on shift workers and workers who make up the contingent workforce. And Shift Pixie is a powerful platform for leveraging the gig economy forces for both business operators and workers. And you can see they have some really big clients such as AIM Recycling, Burger King, and of course Little Caesars Pizza, just to name a few. And let's take a look at how this works for job providers as they connect with qualified live local on-demand workforce. They rethink finding and keeping people on an on-demand bench. They move employer legal, compulsory duties, and risk away from the business. And this is liberation from administrative demands. And this is wonderful for employers, but look what it does for shift workers. And I want you to understand that I live in Orlando, Florida, which is a heavy tourism place, and there are a lot of people who have multiple part-time jobs. So you can see the demand for this technology here alone is impressive, as it gives them to find the flexibility to find work when they're free, to earn and control reliable and regular income, access valuable medical and retirement perks, get live real-time opportunities that are matched to their skill set, and simple to use technology to give them the ultimate control over their work work life. And I can tell you, as I know personally, many people who work multiple part-time jobs and are looking to fill a shift here and there, Shift Pixie is going to be a dominant force in this space, and you have an opportunity to get in early. As a broadcaster or open shift through the shifter network, you get responses from your open shift call from multiple shifters based on the parameters. You can review the available shifters' qualifications and approve and confirm them for the open shift. And what's even better, they even do delivery. And through ZipPixie, businesses can bypass third-party food delivery platforms, allowing them to control the customer experience. Our platform allows a uniform team member trained by the business to handle food deliveries, setting up Shift Pixie to be a dominant force in today's shift workforce. And they just recently announced execution of its second asset purchase agreement to acquire a provider of human capital to several key industrial clients across the western U.S. The seller is a market leader providing recruitment, staffing, and human resource solutions with a deep presence in the western region, growing to an impressive annual revenue exceeding $50 million with a significant diverse portfolio of 100 blue chip companies. The company's strategic operations span multiple states with offices optimally located to serve its valued customer base and loyal contingent workforce of over 10,000 temporary workers. And this is next in our series of acquisitions continues to accelerate our growth goals for Shift Pixie as we rapidly expand our national market presence. This from the CEO. And let's take a look at the investment opportunity here. Again, you can find them on the NASDAQ under the symbol Pixie. That's PIXY. And what we have here is a volume profile line over the last 30 days, and you can see the stock is trading in between some very clearly defined ranges. And as a trader, this is one of the setups you're looking for, because the last two times the stock traded down these levels, it took off for a 37% gain, and now is setting up to do that. The first move is to the volume profile line at 192, which would be about 11% move, and if it breaks out from there, you'll note in the past it just shoots right through there when it breaks out of that volume support level, and that sets up a 37% move to the upside. And as we zoom into the 10-day chart, you can see the buyers have been right underneath this over the last 10 days. There's a volume profile line setting up the stock for that quick 11% move on its way to a breakout. But I'm not the only one who believes the stock could break out. Here you can see from NASDAQ.com, there is an analyst with a moderate buy signal and a price target of $3, representing a potential 70% move higher in Shift Pixie stock. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.